Okay, guys, we're on page 331 of your study guide. Basically, we're going to be going over the various laws. Now, one thing that I'm going to do, I'm going to go over all the relevant information, but when I talk about the disclosures, I'm just going to say you need to know 2 through 7 on this page. And it's just a straight memorization, being able to say which disclosure doesn't work under this act and stuff like that. Now, knowing that chart that I talked about in part 1, that gives all the list. This will give you a basic idea of which act is dealing with it. And so then maybe you can guesstimate on the disclosures if you're not able to memorize. However, I want you to know that all that stuff. Add in the acronyms as well. Fines and jail times aren't really typically important in this one. Chapter 14 are huge. But anyway, let's go ahead and get started on page 331 of your study guide. The first thing we have is Consumer Credit Protection Act, CCPA, and I would note the acronym. The CCPA is basically a blanket umbrella of all the various consumer credit law acts that are on the books. Kind of like Clean Air Act, Clean Water Act, all of them are the blanket umbrella of some of the other smaller acts. Same basic example here for Consumer Credit Protection Act. So how does that apply? One, he just gives you a question that says, which of the following acts, and usually in acronym form, is the blanket umbrella for all the different provisions of all the various acts? And that would be the Consumer Credit Protection Act, or CCPA. The other way to do it is which of the following would be, and then you have a Truth in Lending Act or whatever act you have, and then you also have Consumer Credit Protection Act as a multiple choice answer. Then you've got to worry about that A and B but not C, C and A but not B, because technically it would fall under the same basic idea of an umbrella, so it could apply under both. Now, if you're only given one answer, you go with obviously like Truth in Lending Act or something like that. All right. So let's go over the first one that we have, the TILA, the Truth in Lending Act. Okay, the Truth in Lending Act is also known as Regulation Z. You're going to have like Regulation Z, you're going to have Regulation B, you're going to have a couple of regulations that you need to know as well. Just that's kind of like the formal and informal name of the act. So the Truth in Lending Act, TILA, is also known as Regulation Z. Regulation Z is going to be administered by the Federal Reserve Board as an administrative agency. And it's going to be dealing with any kind of open-ended or closed-ended credit transaction by creditors who usually extend credit in some way. This could be a financial institution. This could be a credit card company. Stores who extend credit like a Macy's or something like that with their own credit card and stuff like that. It includes closed-ended transactions, where that means there's a set number of payments, a set amount of payments, set number of them, and the amount. That would be like a car loan or a mortgage, where it's like a 30-year note or a 5-year note on your car, set payments every month for 5 years, 6 years, whatever it is. Open-ended transactions are going to be ones that until the debt is paid off, it's revolving at usually an annual percentage rate. This would be mainly your credit cards. Credit cards are going to be an open-ended transaction. You don't have to pay it off all at once. You don't have a set amount that you have to pay other than the minimum, okay? But if you keep making the minimum periodic payment, it could take forever to pay off those the amount as well. All right, so Regulation Z is at the very bottom of page 331, also known as the Truth in Lending Act. You'll use those interchangeably on the exam. Regulation Z deals with disclosures of certain things. These are the things that need to be disclosed, and it's A through H. I'm going to read this one because I need to go over a couple items, but if I usually say disclosures of these and just say A through H, you just memorize those. And believe me, don't, because I don't regurgitate it to you, doesn't mean it's not important. Regulation Z requires a disclosure under the Truth in Lending Act for the cash price compared to the total finance. So how much are you going to pay if you paid straight cash versus how much are you going to pay if you did it and at the minimum payment. It's going to tell you how much financial charges are going to be included, along with interest and other fees, which are APR, annual percentage rate. And this is going to usually be prime plus whatever your credit score is type thing. Starting date when it starts, how much the payments are going to be, the number of payments. The amount of payment, number of payments is usually going to be in closed-ended transactions. The minimum amount is sometimes open-ended, but it would be the minimum amount. Late payments and fees and stuff like that will also be done. Regulation Z disclosures must be clear and easy to understand. Now, the minimum Truth in Lending Act covers loans for anything up to $25,000. Okay, $25,000. And that's no longer in the study. Let me go back to the other study guide because it's said in the previous study guide. It's not in this one, I don't think. Let's see. Only covers loans, creditors who readily extend credit. Yeah, interesting. They left out a couple of things in the previous study guide. I don't know if that's an important thing because he just left it out, or it's an important thing because it's no longer applies, but I'm going to assume it applies until I hear it back. It covers loans up to $25,000. Anything over $25,000 is not covered in Truth in Lending Act, with the exception of real estate transactions, i.e. if you buy a house. So to buy a house with those monthly payments and all that stuff would be under the Truth in Lending Act because it is the exception to the over $25,000. And it must be more than 4 installments of payments. So where it says on page 331 of your study guide, by creditors who regularly extend credit kind of midway up, it usually says up to $25,000 and in 4 installments, and it's not there. That has been a test question before, and that's why it's important to talk about it in stuff. If he doesn't talk about it in the video, then hey, go with what is the new study guide. All right, so $25,000 or more, at least 4 installments of the payments. So what if you get a car, and this is why I did the storyline, and this is why I was surprised it wasn't there before. Say you get a car, and the car is $30,000, but you put in a trade-in of another car for $3,000, and you put in a down payment of another $5,000. So you've taken $8,000 off that $30,000. You're going to refinance the rest. That's $22,000 plus maybe you throw an extra $1,500 for tax, title, and license. You're going to refinance $23,500. Just because a car is valued or the truck was valued at $30,000, your loan is under $25,000. And since it's under $25,000, it's going to be more than 4 installments to make the payment on it. That would fall under the Truth in Lending Act. Okay. Now, if it's more than $25,000, the Truth in Lending Act doesn't apply except for home loans. And if you get a home loan, you have a 3-day right to rescind any home loan. Get rid of it and say, no, I don't want this. Okay? Non-home loans are usually enforced by the FTC. Note that. So the FTC is the one that's going to be in charge of the Truth in Lending Act. So, and then also at the very top of page 332, talks about if there's a Truth in Lending Act, you have a possible $5,000 fine, 1 year in prison, and or both. I haven't heard about the fines and jail times associated to Chapter 13. Big in Chapter 14. We made our own chart for Chapter 14, but for Chapter 13, haven't heard about fines and jail times. But I would note that just as a little thing there as well. If it gets to be big, I think I put in their damages as well, fines and stuff like that in that column chart I did for the names. All right. The next one is the Fair Credit Billing Act. And notice he has on page 332 of your study guide, notice he has an acronym form. The Fair Credit Billing Act is also under the Truth in Lending Act. It's just called Part D of the Truth in Lending Act. And it tells you basically the rights and duties you have that are given to the consumer from the credit card issuer. And you get this at the time you open the account and every 6 months after that or so. If you think about it, how many of y'all get credit card statements in the mail? You get a credit card statement, it's usually just your credit card statement, and then a couple of times a year, you get one and it gives like a little pamphlet in addition to your credit card statement. That is every 6 months, they are basically telling you your rights and duties. That's your list because of the Fair Credit Billing Act, FCBA. It gives consumers the right to object to any inaccurate billing that may be on there. Uniform means to protect credit card billing errors from hurting you. If you do have a credit card billing error, you've got to send in your name, address, your account number, claim the inaccuracy and what stuff like that. And then they have time to figure out exactly what's going on. And that is on the bottom of page 332 in terms of how long you can go on. I would look at the bottom of page 332, read over numbers 4, 5, 6, and 7, ending on page 333 of the study guide as well. Now, if you move down, you have the Consumers Leasing Act. The Consumers Leasing Act is a part of the Truth in Lending Act, but it's Part E. It deals with leases. It applies to personal property leased by consumer for personal use. This is lease, not a payment. So if you have the payment plan, stuff like that, under there for buying a car. But if you're leasing a car, it falls under still the Truth in Lending Act, but it falls under Part E that deals with leases. Okay? The total payments cannot exceed $25,000, same as we talked about before. It does not, however, apply to real estate leases. whereas the Truth in Lending Act did apply to real estate transactions. Okay, it doesn't apply in any business because it's only for personal use, so no real estate or business transactions fall under Part E. It's personal use in leasing. Okay, and then it gives you the list of the disclosures, and this is what I was talking about, how the disclosures are very, very important for individual questions. However, me reading them to you when you can probably read faster and or read it, but you do need to know 5A, B, C, D, then go to page 334, E, F, G, H, I, J, K. Notice there's about 8 or 9, 10 of them there that you need to know. All of them can be on there. I would notice it definitely, G I've heard about being on there. And then also, I think it was B or C. I'm sorry, B and D. B and D also I've heard about. So B, D, and G, I would note, just because I've heard those randomly, people have started and told me to basically look at it. But you need to know all 10 to 12 of those. I can read them over, but you can read them over faster than I can probably do that. And then at the very end of that, you have the penalties for it as well. Once again, I put in that chart with the name of the act and everything like that. The only thing you need to add to this chart is probably the acronym associated to each one. All right. The next one is the Fair Debt Collection Protection Act, FDCPA. The FDCPA is directed at collection agencies, what they can and cannot do in establishing and dealing with collecting debts, outstanding debts, collection agencies. Proper manner in which they can do it, what they can and cannot do, what they're allowed, or their limitations. Now, on page 334 of your study guide, and all the way through to the bottom of basically 335 of your study guide, is things that they are forbidden to do. This is that third column, the third column right here. Once again, you have A and D on things they are limited to do, like what time can they only call? They can only call between 8 and 9 your time. So they can't say, oh, well, it's 9 o'clock here and call you at 3 a.m. in the morning. No, they got to call you between 8 and 9. If they call you outside that window, then it's inconvenient hours are limited. They can't do that. They can't call you at work if they know that you have already got an attorney and or your employer doesn't allow you to get personal calls. They can't call you at work, okay? They can't call you at inconvenient locations, i.e. work and home is fine, but other ones would not be. Again, they can't call your neighbor and say, hey, can you put him on the line? That's not allowed. They cannot, they're limited on contacting third parties on what they can and cannot do as well. And then 8, on page 335, 8 has 27 things they cannot do. Now, I have put those in that third column, in that 3-column chart, and I made it more along the lines of, in more layman's terms for you to listen to. But the things that you need to do, they're all there, okay? The ones that I know of, let me go back to my old, the older study guide where I have my check marks on them, okay? All right, you have A on page 335. Now you need to know all these, but A, you have I, you have K, you have N, claiming to be an attorney, that one as well. Post-dated checks, U and V cannot be done. Post-dated checks cannot be done as well, and stuff like that. And I would note H, they can't be a representative of the government and stuff like that. So if they say they're IRS or something like that, they can't do that as well, to collect debt and stuff like that, unless they are the IRS. Okay, so note that. Once they've made the initial notice, then they can contact you with other information as well. All right, so that is the Fair Debt Collection Protection Act. Fair Debt Collection Protection Act, know the acronym, know all 27 in general form. You can memorize those. Like I said, A, you got H, you got K, you got N, you got the ones dealing with post-dated checks, U and V. Those are all ones I've heard, but any of those are possible to be on the exam. You know, and you can read over all 27 of them. And that's what sucks about Chapter 13, don't get me wrong. All right, the next thing we need to talk about is the Fair Credit Reporting Act, FCRA. The FCRA makes sure that bank and other lending institutions have correct credit information. So if your credit score is off because of whatever reason, this is the act that you have protection to get that credit thing corrected and stuff like that. The report can be used. Look at number 4. The report can also be used. I would note all those things in terms of number 4 and 5. So for the Fair Credit Reporting Act, I would note number 1, 2, because it deals with credit reporting agencies, 4 and 5 right there, okay? And then you have the punishment on the other side, but like I said, I don't think punishment's here as important as in chapter 4. I'm sorry, chapter 14. The next one is the Equal Credit Opportunity Act, ECOA. You cannot discriminate in the issuance of credit in the 5 protected classes you already had in Title VII. So when you were talking about chapter 12, we had the 5 protected classes under Title VII: race, color, national origin, religion, gender, i.e. sex. Those are the 5 protected classes. Those are also not allowed to be discriminated against under the Equal Credit Opportunity Act, ECOA. Along with that is you also have age. Age is its own act in discrimination, Age Discrimination and Employment Act, but it also falls under the ECOA. Your marital status cannot be used with some exceptions. Texas, you can use it because you have a community property state, so you could use it in Texas. For a storyline, note that the marital status can be used in certain states, Texas being one of other states where community property is not done, you can't use it. You cannot, the type of income received. If I'm one of those that works as an independent contractor and I file taxes and I don't have taxes taken out, I file quarterly my taxes and stuff like that, that is a different type of income than is what is generated with a salary and the taxes are already taken out. So my type of income received cannot be used as a discriminatory measure as well, as long as it's legitimate income that's legal, okay? Not an Ozark type thing. All right, the Equal Credit Opportunity Act is also known as Regulation B. So we have Regulation Z for the Truth in Lending Act. We now have Regulation B under the Federal Reserve Board for the ECOA. All right, the things that you need to note, what it contains, the Regulation B, what it contains is 2B on page 337, 1 through 6. I would note those as well. They are prohibited from asking information in the application about D, and I think there's like 8 or 9. Yeah, there's 8 because there's 2 more on the next page, 337, and then the 2 on page 338. I would note this, they can ask about a spouse in a community property state, such as Texas, but in other states they would not be able to. They'd be prohibited from asking. They cannot ask about formal spouses, their marital status, alimony, child support payments, gender, and then the one that's always interesting, whether you plan on having more children. That if you say have 3 kids, but oh, we're planning on having 3 more, they may think, well, you can't afford to get anything on credit because you're going to be paying more and more for, raising kids. They cannot ask those questions. I would note 1 through 8 there, especially note in Texas, they can ask about the spouse because it's a community property state. In other states, they probably could not. Okay, damages are at the very bottom there as well. Credit Repair Organization Act, CROA. It basically is truthful disclosures about all information about services credit repair organizations services can do to repair your credit. Now, Swin probably talks about in the video that you can do anything that a credit repair organization can do. It's just if you have the time and all that stuff, everything is available to you personally, is available to a credit repair organization as well. They can streamline it probably faster, and you're going to pay a fee for all that stuff as well. And they may note little things that they can find that and help you with that you may not because you're not as expert in the field, but you have all the capabilities that credit repair organizations have as well. Credit repair organizations that are being unfair or deceptive would fall under this act, and you also have the FTC with unfair deceptive practices from Chapter 11, which you didn't have, so don't worry about that too much. Definition of a credit repair organization is any entity or person involved in interstate commerce that sells or provides services for compensation to fix your credit history, your credit rating, your credit record, and stuff like that. Nonprofit exclusions apply for taxation on that stuff as well. Note that. But basically, the CROA is credit repair organizations. The biggest thing about them is you can do whatever you can do just as easy as they can do. They can streamline it maybe a little bit better. They have to give you disclosures about what they can and cannot do. And then if you bankruptcy file, it is on your credit repair. It's on your credit history, your credit record for 7 years. Okay? 7 years. I'm sorry. Let me repeat that. If you have some things on your credit, it is going to stay on your credit for 7 years. Okay? Unless it's gotten taken off, either by your actions, by the lending institution, if they take it off or whatever. It'll be on your thing for 7 years. If you file bankruptcy, it is on for 10 years on your thing. So say, instance, I'm trying to purchase a house, and I have something from 2016 on my credit history that gives a little ding and lowers my amount. It's going to be on there if it happened in 2016 until probably 2023, 7 years, unless I can get it taken care of. Now, I can get a credit referral organization to do that for me, or I could do it myself. For instance, we had a ding on our house when we bought it, because I had a late payment or something like that with lax furniture, but they had gone out of business. They declared bankruptcy and went out of business. So there was no one for me to contact to try to get it removed from my record, either to pay a fee for whatever to get it fixed. There was no way I could do it. It was on my credit for a long time. We had to buy the house with a little higher credit score than we want, or a little lower credit score than we wanted. And because of that ding, if we buy another house in the future, that has been well taken care of. It's off my record completely. Okay? If you file bankruptcy, it is on your record for 10 years. If it is on and things get taken off after 7 years. So if you have some medical things, because a lot of people don't pay off all their medical bills, it'll be eliminated from your record after 7 years. Okay? 10 years if you declare bankruptcy. All right? All right. If a creditor denies credit under the CROA, they need to let you know and apply for that and let you know why you didn't get credit and stuff like that. If there's inaction in your credit report, that goes under the previous act that we talked about as well. Now, on number 5 on page 340 of your study guide, you need to know 5A, numbers 1 through 5. I would definitely know all 5 of those for sure. And then also the CROA is enforced by the FTC. If you're going to guess, it's either going to be Federal Reserve Board or FTC. This one would be the FTC. All right, the last one we have, I think this is the last one we have, is the Electronic Funds Transfer Act. The Electronic Funds Transfer Act is Regulation E. So you have Regulation Z dealing with the Truth in Lending Act. You have Regulation B that dealt with the Equal Credit Opportunity Act and discrimination. And now you have Regulation E, which deals with Electronic Funds Transfer Act, EFTA. And that acronym has been on test before as well. It deals with point of sale transfers. So if you swipe your card, Square.com or something like that, automated teller machines, direct deposits or withdrawals of funds, debit card transfers, telephone transfers. Venmo would probably fall under this. All those things would fall under the Electronic Funds Transfer Act. Okay? If there's an error, on page 341, 6A through G is going to give you all the different things that fall under as an error under the Electronic Funds Transfer Act. And then number 7, which I really wish you would have moved to the next page, because number 7, there are 3 disclosures under Regulation E. This has been a test question on exams almost every single semester, even going back to all the way to 2003 or whatever it was a long time ago. A has 14 different things. On page 342, there's 14 different things. Yes, unfortunately, all 14 you need to know in general. You don't need no specifics. But it'll ask you which of the following is not a disclosure under Regulation E. Well, if you know Regulation E deals with electronic funds, you can, guesstimate through all the different variations. If you said Regulation B, then you know that's discrimination. You know Regulation Z, that's Truth in Lending Act. But if you get Regulation B, 14 different things right there that you need to know. Okay? They need to give you a periodic statement. This is at the bottom of page 342, a periodic statement. If there were no electronic fund transfers made at all, so note that as well. Now, the last one that I know, well, I'm sorry, there's 2 of them that we need to go. On page 343 of your study guide, what happens when there's an error in electronic funds? Say someone stole your credit card and used it. If you can let your lending institution or bank or whoever know within 2 business days that there was an error, then you are limited to up to $50 and or the amount to transfer, whichever is less. So if you can tell them, hey, no, you're only going to be out $50. If you don't find an error until 2 business days, after 2 business days, between 3 and 60 business days, you're out up to 500 or less, but that's the maximum you're at. If you don't let them know after anything until after 60 days, so the 61st day, and someone's used your credit card and wiped out your account, you can get nothing. You're done. You lose it all. So you need to let them know. If you can find out within 2 business days something's been taken out of your account, the maximum you're out is $50. $500 if it's between 3 and 60 business days. If it's over 60 business days, you're basically liable for everything. It's an electronic funds transfer at point of sale, on ATMs, anything like that. So if someone uses your credit card and knows your PIN number and starts taking out $400 a day out of your ATM, and you notice on day 1 that money has been taken out, you're liable only up to $50 max. Okay. If you find out about 3 or 4 days later, you're only out 400 plus another 100, so 500. If you don't figure it out until later on, if you can go 61 days without even looking at that account and it's all gone, you're screwed, unfortunately, under the Electronic Funds Transfer Act. Now, if there's an error, the financial institution is going to have an investigatory period of up to 10 days. In that 10-day period, they can investigate an error that is made. If they find that an error was made within 10 days, they rectify that error, hopefully to your satisfaction. If they cannot rectify it within 10 days, they will extend it an additional 45 days. However, if they do, they must give the money back to your account. So say, for instance, something was swiped on your credit card and you're filing something and saying there was an error. They are going to look and see if it was an error, and they are going to figure out within 10 days whether or not there was an error. If they can't figure out whether it was an error by them or whatever, or how the error occurred, they will then have to put your money in the account. And this, even though we wrote a check, it's similar to what happened to us when we had our wedding. My wife wrote a check out to the Messina Winery where we had our wedding, and she made it out and left it blank, unfortunately, because the lady said, oh, we have a stamp for that. She put it in her account and didn't put it into the Messina account. Okay? We only found out when we went to Messina and they said, you don't have a deposit on file at all. And so we had to go through our lending institution. They had to go through everything. Now, this was a check, but it would apply, and I'm using a check where electronic funds is going to be electronic funds. I'm just giving you an analogy here. They couldn't figure out what was going on within that 10 days. So they had to give us our $2,000 payment back into our account until they were able to figure out what had happened. Now, if that had been an electronic funds transfer, i.e. we wired Messina off the money or something like that, and it got embezzled and stuff, then that would fall under the electronic funds transfer. But the idea that 10 days extend another 45 days, but they must give you the money in the account so that you're not waiting, say $2,000 is taken out of your account, you may not be able to wait $2,000. You need that money back into it while they fix the error. All right, that is a note. And then also any ATM fees that get paid need to be notified to the people. Whenever you get an ATM, they must be notified either on the ATM machine itself, or you must hit a button saying you understand there's an authorization of money that will be taken out. All right, that's it for chapter 13. Some of the questions in the back of the study guide that are good. Number 2 is pretty good on page 348. Okay. Number 5 is a pretty good question in terms of that's a style of question you have that's going to come into play in regards to some like those disclosures and stuff like that. Number 6 is a good storyline. Mike and Mary are a married couple. Their rural homestead in Texas is, and it says rural. So if you look at that, you're going to have the answer to number 6 is D, 200 acres plus all the improvements. That's a family, so to speak, correct? The one that's interesting is, and number 11, by the way, number 11 is really good as well, okay? Number 11 is good. Number 9 is good because those are the disclosures. And when I talk about disclosures, these are the disclosures in Regulation C. I told you there's about 8 or 9 of those you need to know. Those are in there. The one that I want to look at, the number 16. And I'm going to look, before I even look at the question answer, because I haven't looked at it. I want to look at it real quick. Spencer is a single adult. Look at number 16 on page 350 of your study guide. Spencer is a single adult with no children. His personal property maximum of exempt property is 15, 30, 60, 90, 120. Well, here's the thing. The answer would have been previously B, 30,000. Single adult, 30,000, double it for family. But the answer in the study guide still, if you look at 16, is A, $15,000. It's been a wrong question, and I've told everybody, I get emails all the time. I try to talk about it in the video or in class itself. 16 should have been B, not A. That was a mistake. And now it's a completely bad question anyway, because it's now 50,000, not 30,000. Remember I talked about it went from 3060 to 5100. Okay, so the answer for 16 now should be $50,000. Now, if you change that question up, which is on the exam, Spencer is a single adult with 3 children, say it's 3 children, that now would be $100,000. Or in this storyline, number 16, the answer would have been C, but now we've changed those terms over the last, this is the now second semester. He changed it last semester. Everybody told me in class he changed it last semester. It's been updated in the study guide to 5100, but he did not do any of the questions that you have. He did not correct those at all on there. So 16 should have been B. It should actually be $50,000 now as well. All right. If you have any questions over chapter 13, please notify me. I'm going to, so now you have 12, 13, and 14 should all be there. I'm going to put out a video in the next couple of days dealing with grades and how to figure out your grades, statistically what makes an A, what makes a B, what makes a C. And also in this video, I'm going to go over a list of important things, the most important things for a final exam in previous semesters. And then we're going to and then I'm going to have videos for all the old material as well. Now, I think I'm only going to do for the old material, I think I'm only going to do chapters 1, 2, 3, and 4, and leave the videos up for 5, 6, 7, and 8. All the ones we have. So I'll leave you to do all the old videos, and then I'm going to do chapters 1, 2, 3, and 4. So you have all the chapters would be done, and you would have it at your disposal. But I think the next video I'm going to have, I'm just going to say grades and info is what I'm going to entitle it. When that video comes out, probably after this exam, I'm going to have how to calculate your grade, what to look for in terms of total points you need for an A, B in the pass, and stuff like that, and then give you a list of important things from the exam or from the finals that you need to know, and go over the finals packets themselves real quick, talk about the finals packets, and then I'll make individual ones for chapters 1, 2, 3, and 4 to add in with all the other chapters as well. All right, if you have any questions, email me, text me. I'll be glad to answer you any questions.